In 48 hours, chaos hits. I'll show you why. You need to prepare now. Plus, tonight's show is brought to you by Nurp, and Nurp strategies done anywhere between 18 all the way up to 64% year to date. And yes, fully verifiable. And here's the best part. Nurp software does the trading for you. Yes, that's right. It does the trading for you. Grab the links in the pinned comment and description below to find out how Nurp can start trading for you. Now let's over to Bloomberg, where he picked today's story with a headline as the S&P 500 rally faces an 11 trillion gauntlet of big tech earnings. And I want you to understand what's going on here, because the market has been on a tear despite the fact that we continue to see in the economic data that the global economy is slowing down. And one of the issues here is this could be one of the biggest buy the rumor, sell the news events, because what's happening on Wednesday is going to set the course for the markets for the rest of the year. And so far, Wall Street has won stocks to go up. I'm going to show you why, though. On Wednesday, it's about to change in a major way. This earnings season is off to a solid start, but now all eyes are on quarterly results from Microsoft and Meta platforms on Wednesday and Apple and Amazon on Thursday. The announcement will give investors a key glimpse into the health of businesses ranging from electronic devices and software to cloud computing and e-commerce. But more importantly, it's the Magnificent Seven. And the issue here is something we've been talking about on our Sunday show for several weeks, and that is market breadth. That right now stocks are rallying, but that means that more people are being crammed into the same 7 companies as we continue to see breadth start to fall off. And this is a major problem, because if these companies don't meet their earnings target, well, then watch out. You could see their stock prices start to crumble down. And again, right now, this is the biggest risk in the market, because so far Wall Street's wanted companies to beat. But when it comes to Magnificent Seven, well, the bar now is set high. And a strong showing is critical to sustain the S&P 500's rally. The 4 firms, members of the Magnificent Seven, account for a fifth of the market capitalization weighted benchmark. And again, that is the issue here. Investors all around the world are crammed into these stocks. And we know that the bar has been set high because analysts have told us. But on top of that, these companies are spending hundreds of billions of dollars on AI. And investors have said, yes, we're going to reward you for this. But at some point, the day of reckoning is going to hit. And we need to see all that money you're spending start to turn into income and revenue. The problem is, I don't think we're quite there yet. And the risk now is we could be chasing what may be one of the biggest bubbles in modern history. The problem is, if we see a big miss starting on Wednesday, watch out. If the selling starts to begin, it's going to be a massive move as everybody looks to flood to the exit. And the bar is set high. The Magnificent Seven in particular, they really need to deliver now to keep this momentum going. And believe me, these companies are very well aware of it, because again, if we look at earnings for this last quarter, Wall Street watered down the bar for most companies to hit. But what happened with these Mag 7 companies, they set the bar high. And in turn, what's happened is investors have been flooding in, but due to market cap weighting of the major indices, investors have unknowingly been piling into the same companies that everyone else is buying. The problem is, what we're seeing from Wall Street is they want these companies to miss, and it seems to be for good reason. It's all amping up the pressure on big tech, as many of these companies may need to give rosy forecasts to justify valuations, and that is the problem. At some point, all of the spending on AI has to turn into money, and yet if you talk to people, not many are really harnessing AI. Even fewer are actually paying for it. The question is, how are these companies going to turn hundreds of billions in spend into revenue that's going to impress Wall Street? Well, right now, it doesn't appear that's the case. And if it does happen this quarter, well, watch out. In the quarters to come, the bar that Wall Street has set right now for the coming quarters is going up a lot higher, and that's going to be a major problem, especially as we continue to see the economy slow down. But one of the issues we've been talking about has how everything has to do with the consumer here, and from what we're seeing is there's a major slowdown in spending that's likely to accelerate to the downside. If you're concerned about market volatility, and let's face it, who isn't right now, your portfolio could be missing out on a market-neutral strategy. For decades, large institutions and hedge funds have relied on quantitative trading software to stay ahead, especially during turbulent or uncertain markets. These tools aren't new. What's new is that individual investors are finally getting access. There's a company called Nurp, founded by a fund manager, that's bringing these cutting-edge solutions to everyday portfolios. Their algorithmic software is designed to be market-neutral, means not tied to the ups and downs of the S&P or in a single index. index, it can make a powerful diversification tool. The system is completely automated, so you don't have to make any of the trading decisions. It scans the markets and executes thousands of trades on your behalf using strategies that are uncorrelated to traditional equities. You're not just riding the market, you're managing risk intelligently while still aiming for long-term performance. It trades in currencies, gold, and crypto, and is designed to compound inside your portfolio without requiring constant oversight or any manual trading. You get back your time and still stay in the game. Setup is straightforward, and Nurp offers concierge onboarding, a dedicated account manager, and access to a private user community with strategy updates and live market insights. If you're curious about how this kind of strategy has historically performed or you want to see real results, click the link in the description. Nurp is giving early access to my viewers, and I think it's worth a closer look, especially if you're focused on risk management in any market environment. And to be fair, analysts have slashed estimates over the past few months amid concerns about the impact of tariffs on consumer spending and profit margins. And while big tech projections have come down too, the surge in stock prices has kept expectations elevated. And again, that's the issue here, is everybody needs these companies to continue hitting their earnings out of the park. There is going to be a point where we see the economy continue to slow down and there isn't enough money, there isn't enough revenue to support these lofty valuations. And again, it's all coming back to the U.S. consumer. We know they're pulling back, and that's the problem, because when it comes to earnings, it's the consumer and their spending that really dictates everything. Let's take a look at advanced retail sales in blue, and this is inflation adjusted against corporate profits after tax. That's shown in red, both on a year-over-year rate of change. And I want to take you back to the dot-com bubble, and you can see that retail sales were headed to the downside and corporate profits went negative, setting us up for the dot-com bubble. Then let's fast forward then to the global financial crisis. What happened? Retail sales were on the decline since 2005. Corporate profit growth slowed, but stock prices surged. Eventually, you see profits turned negative, and the next thing you know, we were in an all-out financial crisis. And let's look where we're at now, and we can see the relationship between retail sales and corporate profits, as retail sales now are moving to the downside. And based on what we're seeing in consumer trends right now, the real risk is we could see retail sales turn negative. But at the same time, if you look at investor sentiment, they're exceptionally bullish about the stock market and the fact that it's likely going higher. So what Wall Street does is they set the bar where they want. If they want to beat and drive stock prices up, they drop the bar down. And that's the risk here for Magnificent Seven, is the bar is set high. When we can clearly see the relationship between consumer spending and earnings, the risk is spending is going down, and again, likely to accelerate. Let's take a look at why it's likely to go down as we now overlay average weekly hours of production and non-supervisory employees in red, and you can see retail sales go down because incomes go down. And that's what really matters here. It's not wage growth, it's the number of hours. And we can see the biggest drop in hours worked, now the second lowest level since the pandemic. And right now, again, investors keyed to believing the stocks can only go higher here. Wall Street, again, set the bar deliberately where it wanted to get most of the stocks to move, but now with the biggest ones where everybody's crammed into, the bar is set high. If they miss here, what you're going to find out on Wednesday is the trajectory of the stock market could turn and head to the downside. And as we look at the trade war that appears to be wrapping up, again, it starts to look like the biggest buy the rumor, sell the news event. But there's further evidence. It's not just tech companies. Let's turn to China, where we find out what could be happening next in America, as China's industrial earnings fell for a second straight month, with authorities set to intensify their drive to rein in excessive competition that's dragging down prices and compounding the pain from U.S. tariffs. So what do we see in big tech companies? The same thing. Everybody's racing to have the biggest and best AI. They're spending, again, hundreds of billions of dollars, and there's seemingly no end in sight. The question is, when are they going to turn this into real revenue that's going to justify the valuations that investors have set by driving the stock price up? Well, if what happens in China is any indication, there's going to be a big battle between these companies and a lot of other ones that's going to drive prices down. Industrial profits dropped 4.3% last month from a year earlier after a contraction of 9.1% in May. And that took the decrease in the first half of this year to 1.8%. So again, you talk about earnings and profits, you can see it's all very related here. As China slows down, there's actual evidence of what we're going to see around the world is companies are also going to slow down because there's an increase in competition at the producer level. It has everything to do with the fact that there's a big drop drop in demand at the consumer level. Again, as consumers spend less, producers have less business, they start fighting, and next thing you know, prices start falling. And that's, again, the risk that the U.S. stock market faces here is we have lofty valuations at a time where money is drying up and spending is headed to the downside. But the evidence that's going to hit the U.S. in the same way is very clear. As exports to the U.S. plunged after Donald Trump's tariffs raised the cost of selling goods in the world's biggest consumer market. Again, you're talking about what's happening in China, but what about the relationship to imports and profits? Well, that's the issue for U.S. companies. And that's likely further squeezing the profit margin of Chinese manufacturers. The thing is, it's going to squeeze the profits for U.S. companies as well. And here you can see imports in blue against profits, still shown in red. And what do you see as imports go down, profits go down? You see that relationship happen over and over again. And investors are becoming much more overt and saying, show me the money at these levels, especially for large cap tech. We need to see monetization rather than a promise of monetization coming at some point down the line. And the reality is, as we look forward to the next several quarters, we can clearly see signs that the global economy is slowing down, that U.S. consumers cannot afford higher prices, that the labor market is weakening, albeit slowly, it's still weakening. And that's a problem because at some point, investors are going to say, look, we told you it was okay to spend all this money. Now we need to see results. My concern is this may be the first quarter where these big tech companies can't justify their valuations. The problem is, in the coming quarters, I don't think they have a chance right alongside a lot of other companies. Because one of the things that's happening this summer is not only a decline in consumer demand, but I think there's going to be a bigger drop-off. And the reason? Well, it has a lot to do with weather. The high temperatures have raised alarm for utilities and grid operators from the central U.S. to the Atlantic as people turn to air conditioning. The heat has also slowed rail traffic as trains need to move carefully across heated tracks. But the issue here is all about household finances. And right now, of course, with all of this heat, people are turning up the AC, and that means their electric bills are going up. And as they go up, their discretionary spending is going down accordingly. So at a time when we see U.S. companies desperately needing U.S. consumers to come out and spend in a big way, what they're facing is less money to spend on the discretionary side of the economy, a slowing economy at that, and an earnings season for the Mag 7 that, again, everybody is crammed into with a bar set very high that maybe not all of them could cross. But that's not the only issue we're facing on Wednesday. The other is we're going to finally hear from the Fed. The problem is what we're going to hear is not what President Trump wants. And the Fed is set for a contentious debate as investors eye a fall for rate cut. And I love how the media is spinning this. This is going to be a contentious battle, but yet it really isn't. And we're likely to see some dissent, and that's not terribly unusual, although it isn't common. But the real issue here, what a Fed chief wants is what the Fed chief gets. There isn't going to be any battle internally. I'm going to show you why that isn't what the issue is at all. And even when we don't see any change in policy rate, I think we see hints that we are at a turning point in the policy path. But of course, most of what the committee doesn't seem there yet. I think they're still wary of what happens with inflation regarding these tariffs. And yes, that is the issue at hand here. Because what Wall Street wants is they need two things. One, they need these companies to beat earnings. Of course, what we know as analysts, they set the bar where they want to get people to either buy or to sell. But they also need the Fed to cut. And the reason is everybody thinks if the Fed cuts rates, it somehow magically makes stocks go up. And that would support Wall Street's mantra right now of getting people to put more and more money into these lofty valuations. The problem is the Fed may come out and say, look, we're not going to cut, which Wall Street knows because it's already priced in. The problem is, based on the data, the Fed may say, we're not going to cut toward the end of the year. And that's something Wall Street doesn't want. Let's take a look at what the Fed's focused on. And right now, the reason it's inflation is because when we look at the federal funds rate, what they react to is the unemployment rate. So you can look throughout history and what happens. The Fed cuts rates when the unemployment rate starts to rise. Now let's take a look at where we're at now, because you can see very clearly the unemployment rate is rising, but it's not on a massive trajectory higher. At this point, the Fed likely is going to stand pat on Wednesday. The problem is I don't see anything that's going to give us some sort of signaling or forward guidance that the Fed is likely going to cut in the months to come. We would have to see something like the non-farm pay report, which isn't due till Friday, that give us some indication that the labor market is contracting. The problem is the evidence for that is scant at best because initial claims remain near historical lows. Continued claims slowly are ticking higher, but not at a very quick pace. So what we've heard from employers is they were really concerned about many things. They got the tax cut they wanted, meaning they're now likely to hold on to employees. And for an economy that needs to see a labor market unwind to get the Fed to cut, well, I don't think it's happening anytime soon. And many analysts see a possibility of dissents from Fed Governor Christopher Waller and Fed Vice Chair for Supervision Michelle Bowman, two Trump opponents who have expressed concern that rates are too high given the risk to employment. And again, that is the issue here. You look at what the Fed does is they react to inflation up until it's time to react to the labor market. So what you're hearing from Waller and Bowman is they think the labor market is unwinding. Or maybe there's another reason for their dissent. And some commentators have shrugged over divisions appearing in the vote. In a note to clients on Friday, JP Morgan Chase said they view two dissents as, quote, more about auditioning for the Fed chair appointment than about economic conditions. So what we're hearing from Wall Street is, look, they don't see any issues with the economy at all. In fact, they don't see the fact that the labor market slowdown is a big issue because it's already been priced into earnings. Now, the problem is for the coming 2 quarters, the earnings bar for everybody is going up and up significantly, and that means the economy needs to turn around, including the labor market and demand. But one person was really riled up today, so much he dropped the F-bomb on live TV. And this debate spilled in the mainstream this morning at CNBC, where panelists talked about domestic growth and rates, leading frustration to apparently spill over with Jim Cramer. Quote, our biggest problem is we have so much growth that the Fed won't cut. What the F, he said on live television. It's just our speculation, but it appeared he could have been launching into the question, what is the Fed doing? And the answer is, Mr. Cramer, they're simply reacting to inflation. Remember, it's a dual mandate, and he knows this. He knows it very clearly. It's not until the labor market unwinds, and right now there aren't clear signs that that's going to happen. So if we look at what's coming on Wednesday, we have 2 major issues here. We have this beginning of the earnings season for the Mag 7, which has a bar set very, very high. One, that even if they could cross over, they may not make it over the next couple quarters. The other issue is the Fed. The market wants them to signal a rate cut is coming and soon. Reality is, I think they're going to signal one's coming, but not till the end of the year. And now you know why chaos is coming starting on Wednesday and what you need to do to prepare. And with that, I'm Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.